The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
For the Fed, no rush to cut rates, and for investors, no rush to buy stocks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Busting.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. We're still hovering near those record highs. And if you look at where the S&P 500 is, it's very much in that zone, up by 0.3%. Remember, any gain right now is a new record high, even as the latest Fed minutes showed. Policymakers are not in any rush. I'm looking at home builders as well. The group is down about 2%, and that's with all 18 members in S&P indexes down after Toll Brothers report results disappointed, and housing starts also fell more than anticipated. Not much movement in the bond market here, the 10-year yield coming down 1 basis point, and gold currently also flirting with a record high as well. It did make a new high earlier in the session.
And you look at the stocks right now, 6,146 and change on an S&P 500. That is range-bound in the green for now, but we've been in a tight trading range of about 200 points or so for the past 4 weeks now. Minutes released from the last FOMC meeting doing nothing to help the market break free from that. A reflection of not just malaise about Fed policy and agita over geopolitics, but also what Gina Martin-Adams over at Bloomberg Intelligence calls diminishment in the fundamental strength of U.S. tech stocks. Remember, last year, 58% of the S&P 500's gains were attributable to the Mag 7. So far this year, 4 of those names, Apple, Alphabet, Tesla, Microsoft, are net drags on the index. And the gains from the other 3, NVIDIA, Amazon, Meta, they've only contributed about 20% of the index's upside. In fact, right now, of the 10 biggest point contributors this year, 6 are decidedly non-tech. That includes names like Costco, Walmart, Eli Lilly, and JP Morgan. And so it's that, along with stretch valuations, that maybe helps explain why U.S. markets have lagged this year. You have an MSCI All-World Index, ex-U.S., in fact, on pace to outperform the S&P for a 4th straight month. That would be the first time that this would have happened, Scarlett, in at least 4 years.
Yeah, and here's another way of looking at that same idea, right? The America First trade was a clear driving force behind those double-digit gains in U.S. stocks over the last few years, but not so much in 2025. So the white line tracks the S&P 500 relative to the MSCI World Index, excluding the U.S. It is a ratio, so when the line goes up, U.S. stocks are outperforming the rest of the world. When the line rolls over and slides, like you see here in January and February, that's the rest of the world doing better than the U.S. The blue line, meantime, is the Bloomberg Dollar Index, and it has tracked a very similar path. Uncertainty over tariffs, a less dovish Fed, and lofty valuations have all made other regions look more attractive for now. Romaine?
All right, we kick things off to the close here on this Wednesday afternoon. Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. And Andrew, you're smiling. Are you smiling because you're in love with U.S. exceptionalism, or are you smiling because, well, you've basically bailed out and you're now invested in Europe?
Romaine, yeah, I think why I'm smiling is what scares me the most, what keeps me up at night the most is this retail frenzy into euphoric stocks. And the more that the Fed actually says we're a little bit more on hold, that lowers the temperature because euphoria is the tail end of a bull market. And we're moving too quickly through the optimism phase. So I'm happy if things just calm down a little bit. The Fed says we're not going to cut rates quite as much, and the markets move and start to look for other places. I think that's actually healthy for extending the duration of this bull market.
What does extending the duration of this bull market look like, Andrew? And I mean that in the context of, are we going to look at another sort of double-digit percentage increase for the headline indices, or should we maybe expect something a little bit more modest as people rotate out of those larger cap names, those bigger weightings, into names that, in theory, on their own, can't really move the market?
Well, yeah, I mean, I think that's true. I hear a lot of people predicting that it's over for the mega cap tech stocks. And part of me, Romaine, being cynical is could this be asset allocators who, asset allocation models haven't really worked because all you wanted to buy the S&P? Could it be active management that has underperformed because they didn't own enough of the mega cap tech stocks? Part of me thinks that is a big reason why people are hailing this. I wouldn't bet against these stocks. I think there's many of opportunities beyond that. So I'm not espousing just own them. But I do think it's healthy for the market to see a broadening out. But after 2 great years we've seen in the markets and a lot of kind of buying frenzy gets me nervous where these are weaker holders. Think about this, Romain. If you had bad news that you were long equities in 2023 and you'd held on through 2022, you probably weren't selling when bad news hit in 2023. Yeah. But now we have an all new group of people that have come in the last 6 months, and they're probably more likely to hit the panic button because they didn't, they weren't as invested early in the bull market. And so that's why you tend to get more volatility in the third year, and it's a lower returning year. So I think the likelihood of deeper shocks lowers, actually, if we don't get as much buying frenzy in these retail, these kind of quantum AI type stocks. That's what scares me the most.
How much do tariff threats scare you, Andrew? Tariff threats versus actual tariff implementation. And I ask because we keep talking about how the talk of tariffs is discouraging investors from doing very much, but they're still keeping stocks near record highs. That's
true. I think that's just adds to the uncertainty, right? And the more, Fed on, little less dovish is as uncertainty, yields go, steepening, that makes bonds a little bit more attractive. And the uncertainty of tariffs is another reason why I think it adds to it's not a negative year, but it won't be quite as good as the last 2 years. I think that's accurate. And then, so finally, it's been documented, but this kind of period from late February until tax day, retail tends to sell because they got to come up and pay for capital gains. So that takes the air out of a lot of these, more speculative stocks that have been the big winners year to date. Unprofitable tech is certainly one of them. Okay, so the seasonal factors to consider as well. As we wait to hear more of these tariff announcements, if and when they do come, and depending on how long they are actually in effect for, are there sectors that are just resistant to any of these headlines? I think about financials and how well they've done this year, not just in the U.S., but globally as well. Yeah, I think financials are the big winners because, especially the banks, they're benefiting from the steepening yield curve. Net interest, margin. I think the asset management, wealth management organizations, because with $8 trillion coming, sitting in the money market as the Fed lowers rate, and we can discuss the speed with which they lower rates, as that money comes out into higher returning vehicles, that's good for those industries. So I think financials are a clear beneficiary, but caveat, there's a lot of expectation of a big capital market cycle, and you can see that the private equity and some of the pure investment banks are kind of rolling over, and that's maybe the capital market cycle is going to be more drawn out, which I would actually argue is another reason why we won't get to euphoria, because that's typical a sign of a late stages when you get tons and tons of IPOs and things like that. Well, so I like financials, but again, I wouldn't bet against tech because I think the big thing that tech has going for it is we all know about artificial intelligence, Scarlett, but what we haven't really discussed yet is the profitability, margin improvement broader sectors are going to experience by this, this use of artificial intelligence for things like back office and so forth. That was why the market rallied so forcefully in the late 90s until we know the dot-com bubble blew, right? Yeah. But that's why you had 90, 97, 98, 99 was really the broad application of the internet. I think that's still to come in terms of artificial intelligence.
All right. Well, Andrew, tech stocks are getting a modest bid here on the day. 5 of the Mag 7 in the green. Have to leave it there. Andrew Slimmon, Senior Portfolio Manager over at Morgan Stanley Investment Management, kicking us off to the close here on this Wednesday afternoon with a look at some of the big movers of the day. And that includes Etsy and that includes Bumble taking a tumble on the heels of forecasts that disappointed the street. A breakdown of why investors weren't impressed.
Plus, with President Trump set to speak in Miami in a couple of hours, we discuss the geopolitical headlines moving markets and sometimes paralyzing markets with Stefan Selig. He's the former Undersecretary of Commerce for International Trade under President Obama.
And we're going to talk a little bit more about the Trump administration as it looks to slice and dice federal agencies' budgets. But what is the impact? The broader impact, the ripple effects, if you will, particularly on medical research. A conversation up ahead with Michael Kotlikoff, the interim president over at Cornell University. Stick around. This is The Close on Bloomberg.
Apple has just introduced the iPhone 16e. It's a new low-end smartphone priced at $599 as the tech giant looks to revive growth in its biggest business. The phone will be available starting February 28th. Let's bring in now Mark Gurman, Bloomberg News chief technology correspondent. Is this a low-end phone if it's $599?
Not really, right? If you look at the low-end phone market, you look at what Samsung has with their A-series phones, you look at what Google has with their A-series phones, they're actually both A-series, we're talking between $200 and $400. Apple sort of reinvented the wheel here, calling a $600 phone their low-end model to replace the iPhone SE. This is $170 more than the prior low-end iPhone, so that's a big change for them.
So what is the selling point for this phone? I mean, what is Apple looking to do with it? Because, I mean, again, there's obviously non-Apple competition here that's much cheaper than that. If I go out and get this for $600, what am I getting?
So they've basically taken a full-featured iPhone 16, which costs $700, right? And they knocked off $100 off the price by removing a few bells and whistles that most people probably don't even want. So it's missing a few features like the camera control button that I personally like, but a lot of people have criticized. That's the new button to take pictures with, the manual button on the side. Yeah. It's a cool feature, right? You can zoom in by swiping across it, so that's gone. One fewer camera, so there's only one camera on the back instead of two, which sort of reduces some of the technologies in there, but they kind of make it up with software, so it's not really that big of omission. Some other changes related to the display and wireless charging and whatnot. So for $600, if you look at it as a cheaper iPhone 16, which is how they're marketing it, it's pretty good. If you look at it as a low-end entry-level iPhone, not so good.
Right, right. The other thing that's interesting about this phone is the guts in it, and you point out that Apple created its own chip for this device, which is kind of going to kick off its efforts for the rest of the iPhone line maybe in a year or two.
So this is actually pretty groundbreaking. So there's a new modem in there called the C1. That's the cellular chip that allows the phone to connect to cellular networks when you're not on Wi-Fi. Basically, make phone calls, go on the internet, download apps, etc. They've been using Qualcomm for well over a decade on this component. Now they're moving in-house. So this is the first time they're doing their own in-house modem. They're not really promoting it. I think it's because they don't want performance comparisons. This is not going to perform like a Qualcomm modem. But all things will be great if no one even notices that the change has been made. If you can make your phone calls, if you can download your data, if you can go on TikTok, people are going to be pretty happy, right? That's the big difference in this phone.
So is there sort of a sense, though, because, I mean, I feel like everything Apple does at some point gets sort of iterated. I mean, there's kind of like this flow where, you know, we see some technology, maybe it goes into a cheaper version, or maybe it ends up being a platform for some product in the future here. We've already had two announcements out of Apple in recent months here. They've been basically just updates of the phone, more or less. I know there were some Macs and other things like that here. But is this laying the groundwork for anything bigger?
Well, first I'll say, when it comes to iteration, not innovation, Apple is in its prime. It's iterating a lot right now, right? Everything is another stepping stone. Everything is more iteration. We're not seeing anything particularly new. We're not seeing major redesigns. We're not seeing major changes. You'll start to see those with the new iPhone models this year and next. Very strong roadmap in there. New designs, foldable, slimmer devices.
Yeah.
And the modem is what's going to help enable all of that.
And there's AI in this?
Well, there's AI in these new phones. It has the same chip as the iPhone 16 line, the regular and the Pro.
Okay.
So you can do your Apple Intelligence, you can do your ChatGPT. But if you want something revolutionary in terms of large language models from Apple, you're not getting that here.
All right, Mark Gurman, of course, covers all things Apple for us. The new, cheaper Scarlet Fu iPhone 16.
Cheaper for Apple, not cheaper in the grand scheme of things.
Still a premium product. But speaking of AI, because obviously Apple Intelligence is a big part of that, and we talk about just the use of artificial intelligence and how companies are adopting it. There was a story I saw from Chipotle, really relying on this. I don't know if a few months ago, I think it was in October or November, they rolled out something called Avocado. Avocado, I think is her name.
Yep.
punny. But it's basically an AI system to help with their own internal metrics. And there's a news story out today how they plan to hire about 22,000 seasonal workers, and they plan to make use of this AI tool to help speed up that application process.
That means whenever anyone fills out an application, like you got to make sure it's got to pass all these different filters that Avocado will, put in place.
Needless to say, their press release omitted that particular element of it. But yes, but they do say that it can increase application completion rate to 85% from now 50%.
I don't think people care about that. People just care about getting hired, not help with finishing the application.
Yeah.
That's not the issue here.
Also, 20,000 employees, that's a lot of folks here. They say they're just trying to make sure that all their restaurants are fully staffed. I don't know. Are you a Chipotle person?
No, but my kids aren't. They spend far too much money there.
Yeah. All right. Well, maybe avocado will help bring those costs down. Chipotle shares mired in the muck, just like most else in this market. To the downside, though, Etsy having a pretty bad day today after its latest quarterly print exposed a pullback in consumer spending. A deeper dive as part of our top calls coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we're going to start off today with Take-Two, the maker of NBA 2K and Grand Theft Auto video games. New coverage over at D.A. Davidson, a buy rating, and a street-high $250 price target. The analyst cites an extremely strong set of franchises and the potential to build on that with additional releases this year. The analyst confident this can lead to net bookings growth of 40% or more in fiscal 2026. The share is down fractionally on the day. Next up, Airbnb, an upgrade to buy over at Argus. The price target set at $190. The analyst saying with its strong brands and more than 5 million hosts, Airbnb is well positioned for growth within the marketplace for short-term home stays. This can lead to high teens revenue and earnings growth in the long term, so the analyst says. Nevertheless, the share is down 2% on the day. And finally, Workday, losing a longtime bull over at Morgan Stanley after the analyst cut his rating to equal weight for the first time in almost 4 years. While the enterprise software company had lots of potential during the pandemic, the analyst today sees risk on the horizon after some of the company's recent investments failed to help top-line growth. Workday out with fourth quarter results next week. The shares today down 2%. Those are some of our top calls. We do want to say in the world of earnings, we did get results out of Etsy. And they, weren't good, at least in the eyes of investors. The e-commerce marketplace posted weaker than expected gross merchandise numbers and an outlook that points to ongoing struggles with discretionary spend. Shweta Khajuria, managing director covering global internet stocks at Wolfe Research, joins us now. She's got a pure perform rating on the shares. Let's start with the gross merchandise volume, obviously the key metric, down 7% in the most recent quarter. And it seems to be indicative of softness that we've seen in that metric now for a few quarters. What's going on?
Well, first of all, thanks for having me. It seems like, specifically to the fourth quarter, which arguably for all e-commerce and retail names is the most important quarter of the year, given the holiday season. For Etsy in particular, there are a few things. They experience discretionary spend pressure across the consumer base that go to Etsy. Second is for them, they called out holiday season was shortened versus the same time last year. And so that creates a little bit of a difficult compare. And third, Etsy is a very unique platform where most consumers look at it for gifting, for unique and personalized items. And given that it was increasingly promotional holiday season where most consumers were looking for discounts and promotions, Etsy is not that big on it. And so they likely got a little bit of a share loss during the holiday season to more promotional retailers. And then the final thing is that Etsy does have a pretty great skew. 6 categories account for over 85% of their GMS. So if one of the bigger ones is actually doing worse, then they see an outsized impact. So it's a combination of these factors.
Did management actually try to articulate a way that they would address this, particularly on the discretionary side of this?
Well, they have been at it for now, call it 3 to 4 years. 2025 will mark the 4th year that they will potentially see negative GMS decline, and we are way past COVID. So I guess, number one, investor question around Etsy is, what is going on? Is it Etsy specific, or is it macro specific or e-commerce related? And at this point, it seems it is leaning towards Etsy specific, because the questions are, is Etsy tapping out of its market opportunity, where now it has 90 million buyers, majority of them are in the US. How many more can they get? Second is that there is concentration of discretionary spend, and specifically across those 6 categories that account for vast majority of their GMS. And then third is that purchase frequency has been declining. So they need the same consumers to be buying more frequently. But if everybody looks at Etsy as a unique item gift sort of a destination, then the frequency could be capped out. So that's something that they are working towards with product initiatives as well as marketing initiatives.
So I thought it was really interesting what you said about the promotional environment over the holiday season made people perhaps less willing to go onto Etsy and buy these one-of-a-kind gifts. Who is Etsy's competition then? Is it basically anyone who sells things over the internet and brick and mortar stores?
Pretty much. Arguably anyone who is known for gifting and unique and personalized items, but really in those 6 verticals, 3 of them being jewelry, home and living, and apparel, those are 3 of the top 6 categories. So arguably any offline retailer or online retailer, from Wayfair to Pottery Barn to any of the apparel retailers to Temu, Shein, Amazon, and Walmart, all those are in the competitive set. And ultimately Etsy is fighting for wallet share from consumers. And if consumers are getting a better deal elsewhere, then they lose out on that wallet share gain.
Shweta, I also want to ask you about Bumble, because that stock is also falling quite a bit after its results, too. And I'm wondering from your point of view whether this is something specific to Bumble and how it's operating, or if this is just consumers reluctant to spend on these apps the way that they were before, given the overall environment.
Yeah, I think it's a bit of both. It is a little bit related to Bumble specifically, and we can see that, and the biggest compare here is Match. And Match reported just a couple weeks ago, and we are not seeing as dramatic of a downturn in their top of the funnel metrics as we are at Bumble. So that makes it clear that it is Bumble specific, given that we're not seeing as much at Tinder and Hinge that are owned by Match. It is also a little bit of an industry specific issue because both companies, there is a commonality here, both companies are calling out the hesitation among Gen Zers and the younger generation towards online dating apps, and that there is perhaps a little bit greater competitive pressure for time that they spend on TikTok, Snapchat, Instagram, and social media as increasingly becoming competitive to them. So it is a bit of both. And then on top of that, for Bumble, they also have a completely new management team. I mean, Whitney Wolfe is coming in, who is the founder, who wasn't operating CEO, and then the CFO is leaving, and they also have a brand new leadership team. So it's a mix.
It's a mix of all those factors. Shweta, really appreciate it. Shweta Khajuria over at Wolfe Research. Coming up, the White House argues that reciprocal tariffs are fair, but some experts say there are more complexities involved. Stefan Selig joins us next. This is The Close on Bloomberg.
In order to bring an end to any conflict, there has to be concessions made by all sides. We're not going to predetermine what those are. We're certainly not going to negotiate this today or in a press conference for that matter. But and there are other parties that have sanctions. The European Union is going to have to be at the table at some point because they have sanctions.
And that was Secretary of State Marco Rubio, along with the delegation that accompanied him for that summit to, I guess, end the war in Ukraine. That summit, of course, featured the United States, Russia, Saudi Arabia, but obviously notably absent was Ukraine itself.
Although he did say all parties should be involved.
That is right.
So that's interesting.
Well, all parties are involved here. Alex Hill has the day off. Scarlett Fu is in. I'm Romaine Bostic. 3:30 p.m. here in New York as we keep an eye on U.S. markets. But of course, the U.S. markets have their eyes on geopolitics, whether it's what's going on with this summit, Trump's appearance later today at the Saudi Investment Conference, which is being held in Florida this year, and quite a few other things that could potentially move the markets.
Absolutely. And we've already seen European markets move on hopes that there will be some kind of resolution to Russia's war in Ukraine. European stocks have outperformed U.S. stocks so far this year. European natural gas has definitely been moving on this. For now, everyone's kind of paralyzed, waiting for some resolution, and they may be waiting for a while here.
Yeah, but it's interesting, too. I mean, you mentioned some of the natural gas producers. We saw a lot of weaknesses in their stock, at least prior to today, on this prospect of a peace deal, because obviously they've been benefiting to a certain extent by all of this. And there are a lot of trades out there, if you will, that have been tied to this war. war and the war continuing.
And the war continuing, absolutely. All right, so let's bring in now Stefan Selig. He is founder and managing partner at Bridgepark Advisors. He also served as Undersecretary for Commerce for International Trade during the Obama administration. So, Stefan, I just want to get your take really quickly here on these U.S.-Russia talks to end Russia's war in Ukraine. Ukraine's not attending these talks, but it is being held in Riyadh, in Saudi Arabia, or it was held there. What is the significance of that? Because we know that the Trump administration is eager to restore economic ties with Russia. So it feels like the location plays a role here.
Well, Scarlett, first of all, thank you for having me back. I mean, I think central to the way the president and the administration thinks about almost every issue, there's an economic component. And there's an important economic component as it relates to the global oil industry, where the Saudis are the axe in the market. I also think, importantly, not inviting the Ukrainians and doing it in Saudi Arabia is just a disruptive thing to do. And I think what the president is doing, across, and we'll talk about trade policy in a moment, is just doing things differently because the old playbook hasn't worked. And I think that's at the center of what he is doing. And obviously, it hurts folks' feelings, and it's not the way things have historically been done. And so it is disruptive, but he is the disruptor in chief.
What is the playbook when it comes to trade and tariffs? Because he's talked about imposing them, then he delays it, or in the Colombia case, he imposed it for, what do we say, 6 hours?
Yeah,
12 hours?
I don't know. It was the shortest trade war in history, I think.
Right, and then he pulled it. And then in other instances, he's talking about reciprocal tariffs, and they could encompass a whole bunch of things.
Right. Well, I mean, I think we've seen whether it's the 60% tariffs on China, 10% universal tariffs, just a couple of weeks ago, the elimination of the de minimis exemption for small goods coming into the United States, the 25% tariffs on Canada and Mexico that you just referenced. What he actually ends up doing and implementing isn't necessarily what he talks about and tweets. And so what I have told my clients is be prepared. Don't be cavalier. But on the other hand, don't be presumptuous and don't make moves too quickly until there's a much clearer framework to see actually what's going to happen.
I mean, you mentioned sort of his focus. I mean, obviously a very transactional by nature type of president. At least we saw that in his first term. And that appears to be playing out again. And it's kind of interesting. He's going to make this appearance later today at the Saudi Investment Conference, which is being held here in the U.S. in Miami. And Saudi is, I think they've already committed or pledged to commit something like $600 billion in investments here in the U.S. This seems to be a main driving force for Trump on a lot of issues, whether it's dealing with tariffs and immigration and some of these other issues. If you could come to the table with some sort of monetary benefit, at least as he sees it, to the U.S., that seems to be enough to placate him.
Yeah, it's that, but it also remain, I think, this notion of reciprocal tariffs, he's appealing to fairness. And, reciprocity is, this silver rule, which is don't do to others what you wouldn't want to have done to you. And so I think that is would be very resonant with voters. The question is, while it might be fair, will it be effective? And will it be effective what he's trying to do, which is lower deficits and bring manufacturing back to the United States? And I'm quite skeptical that it will accomplish either of those two things.
But also on the issue, though, of reciprocity, too. I mean, he's made it very clear as well that when he looks at our budget and he looks at our financial issues, he thinks the tariffs somehow can sort of resolve that. The idea that the money that would be brought in would help to balance out tax cuts and other sort of economic proposals that he has. That seems to imply that if he does implement those tariffs, they're not going to go away just anytime soon.
Well, but it also means that we're actually not going to reshore manufacturing. Because if you pay tariffs, that means the goods are still coming onto our shores, and it may or may not be good for the Treasury, but it's certainly not going to do what he has pledged to do, which is bring back jobs to the American heartland, to American factories.
And that's what I wanted to get to. You said you advise your clients to take these seriously, to start making plans. To what extent are they making plans to move their factories to countries, for instance, outside of China or the most vulnerable to tariffs, to perhaps locations that might be friendlier, versus actually moving it back to the U.S.?
Well, I think, Scarlett, folks aren't really doing anything yet. They're frozen. And what that is doing is causing companies not to make investments yet, which obviously has a slowing effect on the economy, because they just don't know, to your earlier question, what the rules of the road are going to be. Are there going to be universal tariffs? Are there going to be 60% tariffs with China? Are there going to be reciprocal tariffs? What is that going to mean? And even this notion of reciprocal tariffs, while some might conclude they're fair, how are they going to be administered? I mean, we trade with over 150 countries. There are something like 130,000 separate items on the harmonized tariff scale. How is that going to be done by U.S. Customs and Border Patrol? It is going to be an administrative nightmare. And as a result of that, people are somewhat chary that some of these policies will actually ever get implemented.
So how effective is it for them to go to Washington or go to Florida and try to appeal to the president himself and say, you know, here's the pressure that we're under. This is the situation we face. I mean, are they getting anywhere with that kind of argument or presentation?
I don't know. From what I've been told, Mar-a-Lago is kind of like an old European court where business leaders are going down to make their case in front of, in this case, His Majesty, to try and get relief and to try and get an audience.
All right, Stefan, always a great conversation. Stefan Selig, founder and managing partner over at Bridgepark Advisors. A closer look here at geopolitical conditions. And of course, we will have a full coverage later here on Bloomberg television of the president's appearance at that conference. In the meantime, we're keeping an eye on something else the president has already done, Scarlet Fu. Right here in New York City, congestion pricing, of course, took effect just a few weeks ago. Most people seem to think it's been a success. The president of the United States says no. He's actually now rescinded what has effectively been an exemption that allowed these tolls to go forward. Basically, this is a toll for anyone that enters the central business district of New York, something that they had to get approval from the federal government, an exemption from the federal government to implement. We're now learned that the Trump administration is rescinding that exemption. Well,
now, of course, that means the MTA has, responded by suing the Trump administration in federal court, saying that the efforts to halt the program are illegal, and they're looking for a judicial order to declare that order null and void. So we'll see how this all shakes out. Yeah. But for now, until the courts decide, if you're driving in below 60th Street, you're still paying that $9 toll.
Yeah, and it's interesting, too. I mean, a lot of us, anecdotally, who live here in New York City and Manhattan specifically, we've noticed a difference. Oh, yeah. I mean, it's very obvious that there are just fewer cars. Much easier to jaywalk. Don't jaywalk, Scarlett. It's legal now, it's okay. But the thing is, too, I was trying to figure out why the federal government is involved, and I went down this whole rabbit hole. I didn't realize that you technically cannot put a toll on any road in America that federal funds were used to build. Oh, I see. Now, you can apply for an exemption, which is how certain roads get around, which is what happened here. But of course, it also means that, in theory, the federal government could pull that exemption.
Okay, so the Trump administration is doing what is well within its right.
So that brings us back to the legal case. It'll be interesting to see what sort of a legal standing New York City and New York State have to hang their hats on. And I know we are expected to hear from Kathy Hochul, the governor of New York, at a press conference sometime this afternoon. And
we know Phil Murphy, the governor of New Jersey, is very happy with this development because they were, of course, firmly opposed to the congestion pricing plan.
Phil Murphy, that guy. All right, guys, let's get back to the markets here. We're keeping an eye on a lot of stocks, and, well, one stock that's not going to be a stock anymore, Nikola. Nosediving today after the one-time darling of the EV industry officially filed for bankruptcy.
That's below $1, isn't it?
That's our stock of the hour, and it's coming up next right here on the Bloomberg. All right, time now for our stock of the hour. A closer look at shares of Nikola below $1 as the EV maker files for bankruptcy protection. A rough road for a company which has struggled with weak sales and multiple CEOs in the wake of a scandal about just how viable its trucks were. Bloomberg senior reporter covering bankruptcies joins us right now, Eliza Ronalds-Hannon. And Eliza, I was just taking a look not only at Nikola, but there's been several sort of bankruptcy filings in the sort of broader EV autonomous driving space, whether it was Canoo, Fisker. I think Northvolt also just recently filed for bankruptcy protection back in November. Is this it? Is this the idea that these companies, which of course came to market with a lot of fanfare, they just were never able to generate the revenue and profitability to sustain things?
Well, it was a lot of fanfare, and that was grounded in a lot of projections and a bit of speculation about just how strong subsidies would be, just how strong the kind of external factors fueling demand for electric vehicles would be. Those subsidies got rolled back, demand cooled, and these guys had put, all three of those companies had put billions into building up the capacity for huge demand. So it's really, Nikola more than anything is an example of just how painful the collapse of frothy markets can be for investors. I mean, shareholders in Nikola, they saw the enterprise value go from almost 30 billion to practically nothing today in a very short time. And it was frothy not only because of just the excitement over electric vehicles, but also it represents the exuberance of the SPAC market. Yeah. It went public through a SPAC in 2020, I think it was. Yeah. And that, we all know that was pretty eye-popping valuations we were seeing over there.
Yeah, it really feels like a sign of the times, this company. In terms of what's next, we know that entering bankruptcy protection doesn't mean the business just grinds to a halt. You talk about how there's an auction and sale process. How does this all play out?
It doesn't necessarily mean operations grind to a halt, but Nikola's attempts to keep operations going have not been successful. They were working really hard to try to find a buyer to take over the operations in bankruptcy and couldn't even solicit any firm interest in that. So that would have been someone taking over at dirt cheap valuations. They had a couple people lined up. They had one strong bidder lined up, fell through at the last minute. I think we wrote about that in the story. Mm-hmm. To not be able to find someone to line up to take over even in bankruptcy is a pretty bad sign. It really leaves Nikola, if anything, forced to just sell its factory.
Yeah, Eliza, really appreciate your giving us the outlook here for Nikola after it filed for bankruptcy protection. Eliza Ronalds-Hannon of Bloomberg News. Coming up, we take you to the closing bell with Ari Wald, head of technical analysis at Oppenheimer.
What keeps me up at night the most is this retail frenzy into euphoric stocks. And the more that the Fed actually says we're a little bit more on hold, that lowers the temperature because euphoria is the tail end of a bull market. And we're moving too quickly through the optimism phase. So I'm happy if things just calm down a little bit.
Andrew Slimmon there over at Morgan Stanley Investment Management, kicking us off to the close just about 50 minutes ago. I'm not sure if you can call this euphoria today. I mean, certainly I understand the broader context of what he's talking about. But we have an S&P that opened in the red, and I guess anything in the green today is going to be a record high. Yes. But it opened in the red, and it's been struggling to kind of hold on to any sort of gains on the day. Yeah,
with not a lot of catalysts to drive it forward or backwards for that matter. But it's interesting that he was talking about this optimism phase because I feel like that's been going on for at least 2 years, if not longer. How long can an optimism phase last?
Well, and that was kind of his point. He's saying, we're now kind of in year 3 of this, and that's kind of when things maybe start to kind of shake out a little bit. The idea of the folks who got in at the beginning of those 3 years, they're sitting pretty because they're sitting on pretty healthy gains. But anybody who came late to the party is probably getting shook out pretty quick.
Absolutely. Yeah. You're looking at green for the S&P, for the Mag 7, also financials, which I included because they're the best performing sector this year in the U.S. and globally. Russell 2000 lagging behind. And interestingly, it is sitting right at its 50 and 100-day moving averages, still well above its 200-day moving average.
Yeah, interesting. Also, keep an eye, too, a big development here in the defense stocks are really taking it lower here on the back of some comments out of the president about potentially cutting the Pentagon budget, or something that would have to go through Congress, but basically saying by about 8%. Palantir, one of the biggest decliners now, down about 12%. And of course, that is one of your biggest gainers on a year-to-date basis, and quite frankly, for the last 6 months or so. Let's bring Ari Wald into this conversation. He's head of technical analysis over at Oppenheimer and Company as we count you down to the closing bells just about 8 minutes ago. And I want to start off with the broader market that is, yes, indeed, sitting at record highs right now, Ari, one way or another, no matter how things shake out over the next few minutes. And I am curious that when you look at some of these technical levels, is there justification for stocks to be knocking on the door of yet another record high?
Well, I'd argue it has been a more lackluster move to a new high. It was very narrowly participated, really just the cap-weighted S&P 500 as we talk about new highs. That's essentially the only benchmark that is at a new cycle high. Most lower cap benchmarks, Russell 2000, S&P equal weighted, still below their peak levels from December. So that is a warning light. It's a divergence. It would suggest again that there's some underlying weakness below the surface in the market of stocks versus the stock market. Now, with that said, if you look at the Russell 2000 and a lot of these other gauges, they're still upholding support. So there's really no major cracks either. So it's which way does it swing? Do we get this rotation back into some smaller and mid cap stocks that could add juice for another leg of this upcycle, or are these divergences going to continue to grow? Of course, in this third year of a bull market, that becomes increasingly more worrisome. Typically, these cycles only last about 3 years. So kind of how we frame it, we're not on borrowed time just yet, but any warnings on a look-ahead basis should be treated with increasing caution.
But I am curious, as we kind of try to maybe look to other indices for direction. I mean, you go back to the Dow theory. I know we're talking about the S&P, but there was always this idea that you need a ratification from the transports to ratify whatever the Dow is doing. Is there anything like that we can look to with the S&P? Is it the equal weight? Is it the small and mid caps to maybe get some ratification that there is something else to propel this rally forward?
That's a great way to look at it. And, Dow theory based on analysis between industrials and transports. And I think similar to what you were leading on to, I would agree that the relationship between large and small cap stocks has become the new Dow theory, if you will. And so I'm based on how Dow theory is interpreted. Right, we're at this point where small caps haven't confirmed this new high, just as transports haven't confirmed either. But to change the signal, they both have to break down. So based on that analysis, the primary trend is still positive. December, all market benchmarks were at new cycle highs. Typically, tops don't develop in that type of manner. Credit spreads are generally holding firm in there as well. So we're kind of in this in-between stage. Again, as you push into this third year, I think there's going to be some about points where volatility erupts again and some better times to buy stocks, but I don't think we're at the end of the cycle either.
Ari, one thing you know in your note, which I found interesting, is that you upgraded utilities and downgraded healthcare because of what typically happens in a third year of a bull market. Yet when I look at the relative rotation graph on the Bloomberg, I see healthcare in the improving quadrant and utilities in the lagging quadrant. What's the rationale for healthcare and utilities and the switch there?
I would argue healthcare has more to do, versus look at some of the relative ratios based on that sector coming off of new relative lows. And I think versus utilities, where you're actually seeing some signs of relative strength creeping into the sector. And we went back and looked at all the bull market cycles, even going back to the 1950s. And found that actually these two sectors have been the top performing sectors in the third year of a bull market. But what we found is that when utilities outperform, it typically occurs at those points when the cycle continues beyond year three. Mm-hmm. Healthcare outperformance in the third year typically occurs when the cycle tops in the third year. So the fact that we are seeing utilities in our work showing better strength than healthcare, again, that's kind of how we framed it, a cycle positive, perhaps. Looking at history would argue for some continued gains looking out through the balance of 2025.
Ari, you started by talking about how, there's some warning lights flashing, at least for the S&P 500. What other warning lights are out there, whether it's in the U.S. or in other regions?
I mean, it's really just the fact that this most recent push to new highs has been very narrowly participated in large U.S. growth stocks. NASDAQ 100 also at a new high. I would say on balance, there's some offsetting positives. I would argue leadership is holding up relatively firm. Credit spreads are holding up relatively firm. And again, there hasn't been any major breakdowns. We found that historically there's a sector culprit going into a major top, which is to say that we found that one topping signal is there's an S&P sector already down 20% over a year-over-year basis going into that. And we don't have that right now. Healthcare has been the bottom performer over the prior year and it's really just flat year to date. So again, I think that just speaks to the typical moderation that you would see in the third year of a bull market. There has been a tendency to see gains moderate following two back-to-back above average years, which we're coming into in 2025. So when you add it up, I think it's all about the selection process, and there's just going to be a market of haves and have-nots.
All right, Ari, got to leave it there. Ari Wald, head of technical analysis at Oppenheimer and Company. Those haves and haves not on display right now as we move closer to those closing bells, with about half of the S&P in the green, half in the red. A full breakdown of all of the market action that we got today and what it could mean for you. That coverage starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you to that closing bell. The global simulcast, it starts right now. Alex Steele has the day off. Carol Massar and Tim Stenovic are in as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol,
yes.
Anything in the green today? It's going to be a record high.
Yeah, a little bit in the green,
Did
right?
you know that coming into this or no?
You know, this is why I count on you, Romaine. We'd be lost without you. We are lost when you're not here.
I love when you patronize me.
I know. Yeah, listen, we did see equities move up a little bit following those Fed minutes. Yeah, it looks like we're going to finish still off the highs of the session, but as you're saying, it could be a record here on the S&P.
Hey, not a record for Bitcoin. Kind of staying within a tight range, sub $100,000 right now, 96,000 at last check. Big question, what's the next catalyst to move in one direction?
Also not a good day for home builders. You have all 18 members of the builders and S&P indexes in the red. Toll Brothers did not give anyone any reason to bid these names higher. Housing starts was also disappointing, too.
And keep an eye on defense stocks. It was kind of interesting to see some news reports here about a potential cut in the Pentagon budget. At least that would be the wish of the president of the United States. That sent a lot of those shares down, including Northrop Grumman down a couple of percent, and then Palantir taking a big leg down about 11 or 12%, despite the fact that it's, of course, one of the better performers that we've had in the stock market for the last few months.
Yeah, it's a good reminder, right, that, you know, even though you look at the major averages and they're up a little bit, there are a bunch of names down in today's session as well.
We are expecting several earnings here in the after hours, including from Cheesecake Factory, NerdWallet, Toast, and Carvana, as we get the closing bells in New York, as well as Klaviyo as well, which is ringing the closing bell there on the NYSE. They're scheduled to report earnings a little bit later this afternoon as well. Green across the screen, and at least for two of those indices, that's good enough for a record high. The S&P 500 right around 6,144 as we wait for these numbers to settle. That's higher by about 15 points or 0.2%. The NASDAQ up fractionally on the day. The NASDAQ 100 at a record high. The Dow Jones Industrial Average also up fractionally by 0.1% or 0.2%. We'll call it up 71 points. The Russell 2000, though, as well as the S&P 400 mid caps, as well as Dow Transports, all sitting this one out. The Russell down 0.3% on the day.
All right, so some pressure certainly on that group. Back to the big caps, the S&P 500. You got 296 names to the upside, Scarlett, 206 to the downside.
All right, and let's look at the IMAP. The 11 sectors in the S&P 500. Definitely a lot of green there. You have healthcare leading the way, up 1.25%. Staples and energy stocks also gaining about 0.7%. Two sectors in the red, led down by materials, chemical company, Celanese, the big drag there, and financials basically unchanged.
All right, let's get to some of the individual gainers as we await some earnings here after the close. Gurman up 12.6%, number one gainer in the S&P 500, rallying to an all-time high today. The company maker of GPS-enabled devices, you know who they are, reported fourth quarter results that beat expectations. They also gave an outlook that is ahead of the analyst consensus. So we've seen quite a move up actually in the stock overall, but a lot of it because of today, up about 17% year to date. Analog devices, again, an outperformer in both the S&P 500 and the NASDAQ 100, reported this morning adjusted earnings per share for the first quarter that beat the average analyst estimate. Remember, last night after the close, the company had boosted its buyback by $10 billion and increased its dividend by 8%. So some outperformance in analog devices. And then one more for you, a microcap. Yes, it's called Serve Robotics. It's up about 13% in today's session. About 11% of the float is shorted. Just going to put that out. But yet some outperformance rallying. It's an autonomous delivery company, and it came out, says it's expanding its services to the Miami metro area with Shake Shack and Uber Eats. So some outperformance.
If I recall correctly, last week it was a big decliner because we learned that NVIDIA, via its 13F, that was one of the companies that they got out of.
Ah, good to know.
I've seen those little robots around LA, by the way.
Have you?
Hey, do you want to talk about some decliners, starting with shares of Intel? Was a big gainer yesterday, up 16%. This all on speculation that the company would be broken up in a deal involving TSMC and Broadcom. And in fact, last week was its best year, going all the way back to the year 2000, giving back some of those gains today, falling by about 6%, still up 35% just from February 11th. And shares of Bumble just taking a tumble today, down 30% in the session. The company gave a first quarter forecast that was weaker than expected on key metrics. First quarter revenue came in below estimates. First quarter app revenue, that's seen as below estimates. First quarter adjusted EBITDA, all of this guidance came in weaker than expected. We saw price targets cut at Stifel and Evercore ISI. And finally, Nikola finished the day down by 39%. It was once a darling of the EV industry. The company filed for bankruptcy. It's exploring a sale of its assets after entering Chapter 11 in Delaware. The company listed total funded debt and lease obligations of $98 million. They've got $47 million in cash on hand. You remember Bloomberg News reporting a few years ago that Trevor Milton, the founder, had overstated the capability of Nikola's debut truck. Those allegations, coupled with subsequent short seller campaigns that led to Milton's ouster and later conviction on fraud charges.
All right, let's take a quick look at yields. Kind of a mild day in the Treasury space here. Yields were down pretty much across the board, but only really we're talking about a basis point or so. Keep an eye on that 20-year yield. We did have an auction earlier here in the day, and that day actually did tail heading into that auction for a third straight time here, suggesting that investors are starting to demand a little bit of extra yield here in terms of buying into those new issues coming out of the Treasury Department.
And of course, the big story of the day, at least if you live in the New York area or commute into the city, is the fact that the Trump administration has moved to block the city's congestion pricing program. We're, of course, waiting to hear from Kathy Hochul, the New York State governor, on how New York State will respond, although, you know, they have sued to stop this move by the Trump administration. So the MTA, at least. So we'll see how that all shakes out. But
Carol, you were against this, right?
No, I think it's a good thing.
Carol's not allowed to be for it or against it. Don't you know how it works here?
Wow. No, but you know.
Are you just saying that because she's from New Jersey?
I was, yeah.
Okay.
I thought everyone in New Jersey hated it.
No, but I was going to warn you guys, don't mention it because Tim's head might explode. But having said that, it really, to me, opens up this whole idea of, do states have any control over what they are doing within their states? And I am curious to see how legally this ultimately will play out.
I went down that rabbit hole, too, because I couldn't understand why the president would have say over this. But it gets to this idea. Apparently, there is a law in the books that basically says if you build money and you use federal, or you build a road and you use federal money to do so, that means you can't put a toll on that road unless the federal government gives you an exemption.
Huh. All right. Devil's always in the details. Yeah. Man, I love
so
when
you learn something new.
I love when you do the deep dives. All right, let's get to NerdWallet. Some earnings crossing the Bloomberg terminal. Fourth quarter revenue, it's a big beat, $183.8 million. The street was looking for $168.7 million. Fourth quarter adjusted EBITDA, $30.8 million. That, too, above the estimate of $22.9 million among analysts. Fourth quarter EPS, earnings per share, 51 cents versus a loss of 3 cents a share. That's year over year. And I'm just looking at NerdWallet. It is up, as you can see, almost 4% here in the aftermarket.
All right, I'm going to take a look at Klaviyo. This is a company that does kind of like text messaging and sort of email stuff for businesses to better target folks. They're out with their earnings, and the shares are higher in the after-hours trade. This after fourth quarter results on a revenue basis jumped 34% in the most recent quarter, $270 million. That's above what the street was looking for. Operating income was down, though it was still higher than what the street was looking for. So a drop in operating income, but not as bad as some folks had thought. And the company gave a forecast for the full year saying that revenue will be $1.16 billion roughly. That's slightly higher than street estimates.
All right, let's go over now to the news conference that the MTA is hosting in response to, of course, the Trump administration moving to block the New York City congestion pricing plan. Here is New York State Governor Kathy Hochul.
Battles were fought. We stood up to a king, and we won then. And we will, in case you don't know, New Yorkers, we're in a fight. We do not back down. Not now, not ever. Because who are we fighting for here? We're fighting for our residents, our commuters, our riders, our drivers, our emergency personnel. Life has gotten better for even those who have asthma, people with illness. That's who we're fighting for. And the 6 million people who use the MTA to get to their jobs and their lives and their doctor appointment, nurses, doctors, EMTs, all the people we need to get to their jobs in a reliable way, they're now going to be affected. So I also have to raise a question. As I look at the pretext for this rejection, and we have a lot of legal reasons why we know we're going to be victorious, but they actually cited the will of New Jersey. New Jersey didn't want this. Ignoring the will, the people who live here, they're elected leaders in Albany, and all of a sudden, the Trump administration is citing, well, New Jersey wasn't happy, okay? I will talk about that later. But here's what I want to also say. I don't care if you love congestion pricing or hate it. This is an attack on our sovereign identity, our independence from Washington. And this is, we are a nation of states. This is what we fought for. This is what people like Alexander Hamilton and others fought for, to set up a system where we are not subservient to a king or anyone else out of Washington. So this is the fight we're in. It's all about our sovereignty. And I spoke to the president many times in a reasonable way, calm way. You're a New Yorker. You know how essential it is to have safe, reliable public transit, or else this system shuts down. Our economy shuts down. The nation's economy could shut down. That's how essential we are. And one would think he would know that. And then you have others involved. I mean, it feels like the commuters of our city and our region are now the roadkill on Donald Trump's revenge tour against New York. And I have to say this to Secretary of Transportation Sean Duffy. It's not the real world, Sean. It's real life for New Yorkers, and don't you forget that. So, we're in fight mode. Within seconds of us getting this notification, our MTA was prepared. We knew this could come. Filed a lawsuit within minutes.
And we're listening to New York Governor Kathy Hochul in New York City right now, responding to the news that we learned about earlier, and that's the federal government rescinding the exemption that allowed New York City to implement congestion pricing in its main business district. Of course, that was a long time coming, something that voters themselves voted on, something that had been approved by both the state government and the federal government. Donald Trump, though, a little bit earlier in the day, making it clear that he plans to rescind that exemption. You can continue listening into the comments by Kathy Hochul on your Bloomberg terminal by typing in live. Go.
She's fired up. I don't think I've ever seen or heard her this fired up.
She's fired up, taking a little pot shot there at Sean Duffy, who, of course, the Transportation Secretary of the United States of America, who in a prior life was a real world contestant. Remember that show?
Yeah, she made a mention about the real world.
So anyway, she's got a sense of humor. We'll see how all this shakes out here. Meanwhile, an interesting shakeout in financial markets today, particularly when it comes to the S&P 500. Look at that, Scarlett. It's only up 0.2%, but that's a record high.
Good enough for a record high, right? I mean, it didn't look like we were going to get there this morning.
Yeah, absolutely. And we can talk about a 0.2% gain. It was a middling gain, and we should point out that for all the strength that we saw in some sectors, there was a lot of weaknesses in others. That includes in defense stocks, and that includes in home builders as well. Not much movement today on that 20-year yield. Not much movement across the Treasury curve. But once again, we did see modest dollar strength.
All right, let's take a look at some individual movers as well. Solar Edge closing up about 16%. It did gain as much as 34%. The sales at the solar equipment makers company topped estimates, and it did generate free cash flow, positive free cash flow. And so the results led short sellers to cover their shorts. It's a highly shorted stock. Wingstop losing about 13% on the day. The restaurant chain reported fourth quarter comparable sales that missed estimates. On top of that, it faces difficult comps for this year, and full year revenue growth is now seen slowing. Our top story this hour is Trump's flood of policy announcements causing paralysis across industries, starting with the oil market. Traders reducing their risk exposure after the president railed against OPEC, pushed for an end to Russia's war in Ukraine, and also threatened tariffs against countries that supply crude. You look at implied volatility for Brent, and it fell to its lowest since July. Then there's higher education. A cut in federal funding for the National Institutes of Health means a hit to the nation's top research universities. Later in the program, we're going to speak with the interim president of Cornell University on this development.
Of course, everything in the market right now continues to revolve around what's going on in Washington. Our next guest weighing in on the current geopolitical environment, saying, quote, U.S. multi-factor mid-cap funds could offer investors a safe haven. Dina Ting joining us right now, head of global index portfolio management at Franklin Templeton. And Dina, I mean, we talk about this idea of whether investors are even looking for a safe haven. And if they are, where do you go? Do you buy treasuries? Do you buy the dollar? Do you just go outside the U.S. altogether? You're saying that you can find maybe some safety in U.S. stocks right here at home.
Yeah, so there are definitely pockets of opportunity, right? Usually, environment of change is an opportunity for having a potential place where you can park your money. Looking into mid-cap, you probably hear the story that given the focus on domestic manufacturing and given the potential for the tariff wars around, putting your money into mid-cap, especially a multi-factor mid-cap that looks for profitable, high-quality company at attractive valuation could be a place to be.
Now, just to be clear, Dina, though, some of that also includes stocks outside the U.S. And we started this year off with a tremendous outperformance that we've seen in Europe and Asia relative to U.S. stocks. And stocks here in the U.S. are doing well, up 2 or 3%. But you're seeing double the gains right now, on a dollar basis at least, over there in Europe, and even significantly more when you look at Hong Kong and some of those beaten down Asian markets there. Are you also advocating that investors maybe take a look there as well?
Yeah, so the mid-cap, what's interesting about mid-cap is the sector that make up the mid-cap is typically different than what it is you can find in large cap, as well as like the domestic capacity. You mentioned a few countries. One thing that comes top of mind is India as a country that has grown significantly in the past few years, right? Their economy is growing, bypassing large economies such as UK and France. But if you look at the FLQM and the mid-cap factors, what matters in a way is what's driving the performances. So in FLQM, industrial, consumer discretionary, and financials are a big sectors that made up those companies. And if you look at the countries such as India, and I think this is where we can find that in Trump 2.0, the ability to finesse relationship and negotiation plays a big factor in creating a better outcome for each of these countries. If you look at India, the world reciprocity is being repeated over and over, right? Because it is ability to be able to understand when you bring to the negotiating table, you have to be on the same wavelength and being able to bring in what is needed on both parties, and maybe you can find a win-win situation.
Right. I mean, Modi and Trump famously got along during the first Trump administration. You also include Mexico in that category, and there's been a lot of praise given to Mexico's president and how she's managing that relationship. Of course, the president of the U.S. had wanted to impose tariffs that's been pushed off for a month. So is now the right time to get into Mexico when there's still so much up in the air?
Yeah, so Mexico, I would say, is like the dark house that people don't expect. And it all comes down to that 45 minutes of conversation, right? This could be like a future playbook of how you negotiate and avoid a worst case scenario. One thing about Mexico, yes, they're dependent on the U.S. in terms of economy, but the geographical proximity, it's something that is unchangeable. And from a pragmatic point of view, that is a benefit that you just cannot overlook, right? So yes, there's volatility, but yet year to date, it has been a strong performances in Mexico. And if you look in 2023, it was the best performing country.
All right, Dina, really appreciate your joining us today. Dina Ting is head of global index portfolio management at Franklin Templeton, suggesting that we look at individual countries through ETFs as a way to maybe navigate the current situation, the current geopolitical situation. All right, coming up, we are breaking results for you. We've got some numbers that did cross remain, including from Carvana and Cheesecake.
It's interesting here on the Carvana numbers here. I've just been kind of taking a deeper dive into these. The shares down in the after hours trade. They beat on all the key metrics in the quarter, including on EBITDA margin, including on EBITDA, including on revenue, $3.55 billion. That's above what the street was looking for here. But the negative reaction in the shares, and we should also point out EPS, also a big beat, 56 cents versus a street estimate of 31 cents. But the forecast going forward, while it does sound bullish on the surface, it looks like investors were looking for something more. Carvana says it still sees a sequential increase in adjusted EBITDA for the first quarter, as well as a sequential increase in actual retail units sold in the first quarter. But it does look like, at least based on the press release, that they're a little light on details, and that might be some of the concern. We still have a conference call that we're waiting on.
All right, and let's also take a look at Cheesecake Factory, that restaurant chain reporting results. For the revenue line, better than expected for the fourth quarter, $921 million. That's up 5% from the same time last year, higher than the consensus estimate. Also adjusted EBITDA of $1.04, topping the consensus estimate of 91 cents. So that stock up about 1% right now in after-hours trade. So coming up, we're going to break down these results a little bit further and get some more context on what these numbers suggest. This is The Close on Bloomberg. Let's turn now to the restaurant industry. Shares of Cheesecake Factory are on the rise in after-hours trading. This after it reported sales and profit that did beat analyst estimates. Let's bring in Michael Halen of Bloomberg Intelligence now to get some more context. And Michael, the beat in the fourth quarter pretty much aligns with casual dining or restaurant dining doing a little bit better in the fourth quarter.
Yeah, the industry data that we get from our partners at Black Box Intelligence showed that, post-election spending picked up, particularly at casual dining restaurants. The fourth quarter was a little bit better than we had seen through the first 3 quarters of 2024. And Cheesecake Factory was a beneficiary of that. Their same-store sales beat at their namesake chain, which had one less week in between Thanksgiving and Christmas. So considering they have a lot of their stores based in malls, this was a good top line result.
I am curious about the cost side of this. When you look at their margins and you look at the bottom line, Michael, how are they sort of approaching this? We talk a lot here about inflation and, of course, the increased costs of food and labor. Is Cheesecake Factory affected?
Yeah, and we in our 2025 outlook, we are most concerned about inflation this year. We think sales will be a little bit better, but inflation we don't see going away. Cheesecake Factory is going to do it 2 ways, hopefully, for them. Number one, through modest price increases, right? I don't think they want to get too aggressive with price increases after 2024, where low-income consumers kind of push back against those. And then also trying to drive traffic, right? Like if you can drive traffic into your restaurants, that positive operating leverage can, give you some margin expansion, even if your labor costs and your food costs are higher.
Are they going to do anything drastic like reduce their menu, streamline their menu, or maybe even shrink the portion sizes? God forbid.
Not Cheesecake Factory. I mean, they really see value as what you get for what you pay. And that's, big servings of good food with good service. And that's why people love Cheesecake Factory. And we don't see them moving away from that anytime soon.
All right, Michael, great stuff. Michael Halen over at Bloomberg Intelligence, a deeper dive into those earnings that we just got out of Cheesecake Factory. Cake up about 1% here in the after-hours trade. Meanwhile, to the downside is Carvana, down more than 8% following results. The used car retailer basically saying that, things were good. Revenue was up. EBITDA was up. Margins were wider, yet the stock is down. David Welch, our Detroit bureau chief, joins us right now to talk a little bit more about why. I'm not quite sure here. Even the forecast they gave, and I know they don't give very detailed numbers when it comes to their forecast, but just saying, hey, we're seeing sequential growth in that area. I looked at the number of units sold. That was up as well. And I looked at the profit margins, David, 10% profit margins. You compare that to AutoNation and some of the other competitors there, that's well above what they're doing. Why aren't we seeing more of an upside reaction in the shares?
Yeah, that's a good question. I've been trying to figure that out myself because the numbers all look good. It's a fairly rosy forecast for the year. Not a lot of specifics to it, but they are seeing EBITDA growth. They are saying they're going to have unit growth. Used car market remains pretty strong. So, there's not a lot of downside here. There could be some profit taking. And then sometimes aftermarket trading is just a little tough to read. Then the next day, the shares actually move in the other direction when the market opens. But stock's been up a lot. You could maybe see some potential profit taking here. But I guess we're going to have to wait till tomorrow to see how they react once the market's open and there's heavier trading volume.
Yeah, it rose 284% in 2024, the stock that is, going from $53 to about $203. So, David, in terms of putting this Carvana results into context, how does it look when you match it up against Ford and GM?
Look, the new car companies have some different challenges here. They've got potential of tariffs. Interest rates look like they're going to remain high, and that's something that's really hurting consumers and starting to bite. And I would think that if it hurts new car buyers, where prices are very high, those people will go into the used car market, and we've seen some of that. But that could be another concern of the market here, is that we do have relatively strong pricing, and we do have still pretty high interest rates. That keeps some consumers, either new or used, on the sidelines, not buying anything for a while and just repairing their cars and soldiering on with what they have rather than going to buy. There is some uncertainty here. So the market could be seeing very good results in the fourth quarter and saying, hey, this could be as good as it gets. And as far as the company's forecast, we'll wait and see, given some of the macro factors out there in the larger vehicle market and with interest rates.
Yeah, it'll be interesting to see what management says on the conference call, which I think starts at 5:30 Eastern time. David, what is the pricing, though, look like, the pricing differential between used and new cars? Because for the last few years, certainly during the pandemic, there was kind of that lopsidedness to it where if you were looking to save money by buying used, you really weren't going to save a ton of money, at least not that gap that you would typically expect. And that drove a lot of people just to go and buy a new car. I say, hey, look, if I'm going to pay this much and, for $5,000 more, I can get a new one. Why not?
Yeah, those massive premiums in the used car market have gone away. That was all driven by chip shortage, which led to a vehicle shortage. There just weren't new cars on the market. So you had some used vehicles with 20,000 miles on them selling for more than a comparably equipped new car would have. That kind of craziness has gone away because there's plenty of inventory. Actually, there's a lot of inventory on new car lots. But you do have, pretty good pricing in the used car market. It's not, crazy record levels, but it's been pretty stable, which is good for companies like Carvana and AutoNation and the others. They're not buying inventory into a rising, or rather falling market, and they're not, trying to sell into one that's rising and missing out on profits. So they all should be able to do pretty well in this kind of market, especially if there are some concerns about interest rates and new car pricing.
All right, David Welch, Detroit Bureau Chief, thank you so much. And of course, we look forward to finding out exactly what Carvana says in its conference call that could help explain the negative reaction we're getting to the shares in the after-hours trade. Coming up, President Donald Trump due to give an address at a Saudi-backed investment conference. We're going to check in with our reporter who is on the ground in Florida next. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Marty St. George. He's the president of JetBlue, and he says JetBlue will absolutely pursue a deal if the right terms are found. Of course, JetBlue wasn't able to get its merger with Spirit past the regulators, and of course, it was also forced to dismantle its joint venture with American Airlines.
Yeah, and I'm actually intrigued by this because there's been a lot of talk as to, with the new administration coming in, whether some companies would try to revisit some of the deals that either got blocked or at least got the hand. And you talk about Spirit, and of course, remember they had the alliance with American Airlines that also got scuttled as well. So it'll be interesting to see whether they actually make good on that. And we've actually heard from a couple other executives saying that we could see a revisiting of some of those deals, not just this one, but some others. Yeah, and I'm sure this is something investors are keeping a close eye on whether they want to sell or not. I'm also keeping a close eye on Cantor Fitzgerald and, of course, its CEO Howard Lutnick, who is moving on. Of course, he is now the U.S. Commerce Secretary. And now, to lead his company while he's gone, he's tapped two of his sons here. Brandon Lutnick is going to be chairman of the company. He's 27 years old. And Kyle Lutnick will be executive vice chairman. He's 28
I know, that's what I couldn't get over.
So congratulations to those two. We should point out that the core businesses that the company has, the private brokerage, the investment bank, that's going to be run by some of the veterans who've already been there, like Sage Kelly, as well as Christian Wall. So, I mean, there's obviously some very seasoned folks that are still going to be running operations, but Brandon and Kyle, his two sons, 20-plus-year-old sons
I know.
are going to be basically overseeing things, and maybe that's a better way of putting it.
Yeah, that was where I kind of stopped
Yeah.
reading because I was thinking, wow, that's a lot of responsibility at that age. So
Yeah, it
good luck
is.
to them.
Yeah.
All right, third on the docket, Kamala Harris, the former vice president, signing with Creative Artists Agency. So they now represent her, Romaine, in, I don't know, whatever deals she makes, like writing a book or hosting a podcast, or I don't know, what do former elected officials do now?
Make a lot of money, Scarlet Fu, which is
Speaking
probably why CAA signed her.
Yep,
and we should
speaking
point out
circuit.
too, this is pretty standard here for outgoing members, at least prominent members of the government. We should also point out that at CAA, of course, one of her, I guess, label mates, I don't know what we call them, will be Joe Biden, who of course also is represented by CAA. All right, speaking of politics, we are keeping an eye on Donald Trump. I don't know who's representing him, but he is expected to take the stage
himself.
at a Saudi-backed investment conference, and it's actually taking place this time not in Riyadh, but in Miami. Our very own Tyler Kendall is on the ground in Miami. And Tyler, what are we expecting to hear from the president in the next hour or so?
Yeah, hey, Romaine. Well, when President Trump takes the stage, expected 5 p.m. Eastern, we're expecting him to discuss this idea of increasing investment in the United States. We know that during his first week in office, the Saudi crown prince called him up and said that Saudi Arabia would invest $600 billion in the U.S. over the next 4 years. Well, President Trump would like to see that number go higher. It has still attracted business leaders across the country here to Miami in order to hear about this and potentially how an increase in capital flows between the two countries they could potentially capitalize on. According to the Bloomberg Billionaires Index, there's a combined wealth of over $100 billion that are going to be attending here at this summit. And there's a real sense on the ground that the Saudis would like to focus on areas of agreement. Think investments in artificial intelligence or advanced manufacturing. I spoke to one foreign policy expert here on the ground who told me that the Saudis really feel like they have more direct contact with President Trump and his orbit compared to what was often an interagency approach under the Biden administration. So where President Trump goes with his speech tonight remains to be seen, if he will hit on some of these areas of agreement, including that Saudi Arabia hosted those high-level U.S.-Russia talks just yesterday. But of course, Romaine and Scarlett, there are still other big points of contention, including President Trump's plan when it comes to the future of Gaza, as well as some of his recent criticism about oil prices.
All right, Tyler Kendall, thank you so much for the wrap-up of what we can expect today in Florida. Tyler Kendall in Miami. Now, President Trump's pledge to cut government spending has now led to reduced funding that enables medical research at universities. And at stake is the money that universities get reimbursed for expenses, including laboratory buildings, equipment, and staff. These are all known as indirect costs. Here now to offer a defense of the spending and funding, I should say, is Michael Kotlikoff, interim president of Cornell University. President Kotlikoff, welcome. Thanks for joining us.
Thank you for having me.
You are also professor of molecular physiology, so you know firsthand the value of public funding for medical research. What we're not talking about here is direct funding for medical research. This is like indirect funding, yes?
Correct. Thank you. This is the operating costs that really fund the infrastructure for that research. So universities build buildings and attract faculty. Those faculty compete for research grants. If they're funded by the federal government, through a partnership of over 7 decades, agrees to fund only the operating costs of those laboratories that they've decided to fund. That's the heat, the light, the biosafety infrastructure, and also the administrative costs, the cost of administering and overseeing the grants and reporting back to the federal government.
Let me ask a dumb question. If the direct funding for the actual research itself is not affected, and we're talking about the, costs that go along with it, the operating expenses, why not tap your donors, your alums who give so much money for buildings and other infrastructure on campus to cover these expenses?
Yeah, that's not something that donors typically support. They do support research costs, but the actual unsexy operating costs are not something typically that donors will support. I would step back. This is a critical partnership that we've had for a long time, and it's really been so successful for the United States. It's led to discoveries that have helped patients. It's created this virtuous cycle of innovation and entrepreneurship. And those discoveries have then gone on to be developed by biopharmaceutical companies to create the medicines that we all take. This has been something that's been the envy of the world, something that's attracted genius from across the world and saved patients' lives over and over. So it's really a critical issue. The NIH is really the crown jewel of federal funding, and destabilizing it in this way, in this acute way, is really dangerous.
How do you go on, though? If that funding is removed, the indirect funding is removed, how do you go on?
Well, a lot of research will have to stop, I'm afraid to say. It will stop, and it will cost people's lives over time. Absolutely, it will.
Who is going to make the decision as to what should be stopped? Is it going to be the individual researchers, or is this going to be more at a high level at the top of NIH or something?
Well, I think the NIH will have to adjust to understand how these costs will be handled overall. One of the things I would say is that I think universities are very willing to engage in conversations about how we can cut these costs. For example, federal regulations have accreted over time. But this partnership is something that has lasted for a very long time. It's very successful. My lab was funded for 40 straight years by the NIH. I've seen this work over and over with colleagues, and it's something that would be really terrible to see destabilized.
What's your response, though, to people who ask why there is so much government involvement in this? They would say, well, shouldn't we just let the private companies, the pharmaceutical companies, et cetera, do this work?
Well, I think that the government made the decision some time ago that this is the most efficient way to do it. If the government built the buildings and tried to recruit the scientists, believe me, it would cost a lot more and produce a lot less. And pharmaceutical companies are quite averse to the risk associated with basic research. So this allows basic research to occur and to be de-risked to a point where pharmaceutical companies can say, that's a great idea. We're going to now take this forward and produce a product.
All right. Well, we have to leave it there. I really appreciate you taking time to talk about a really important issue. Michael Kotlikoff is the interim president over at Cornell University. All right, stick with us. When we come back, we're going to take a look back at this day in history and Mark Zuckerberg's biggest ever acquisition. It's the deal that brought WhatsApp into the Facebook empire. This is Bloomberg. All right, let's take a look back at this day in history, all the way back in 2014 when Meta Platforms agreed to buy WhatsApp, a roughly $20 billion deal that to date remains the most money Mark Zuckerberg has ever paid to buy another company. And while it was derided at the time as being too costly, WhatsApp came along at a precipitous time for Meta. Facebook's main platform was almost a decade old at the time, and in the fast-moving world of tech, was really starting to show its age, particularly as a new generation of social media users were gravitating to mobile-first apps like Snapchat. While WhatsApp had about 450 million members at the time, less than half of Facebook's, the mobile-first messaging service was adding about 1 million users each day, way faster than Facebook. The deal came 2 years after Zuckerberg bought Instagram for similar reasons, but for a relative steal of just about $700 million. Today, at a valuation of more than $100 billion, Instagram is considered one of the greatest corporate purchases ever based on the return on investment. And while Meta doesn't detail financials for WhatsApp, it's widely considered to be a bit of a financial dud. The business was only generating about $10 million in annual revenue at the time of a deal, primarily through a subscription model that has since been scrapped in favor of an ad-based model. And that brings us back to the future. What is the true value of WhatsApp to Meta? Analysts at William Blair last month say Meta's push into AI services for businesses may finally provide that answer. Meta already offers click-to-message ads on Instagram and on Facebook, a style of revenue that Zuckerberg says is generating more than $10 billion in revenue. Deeper integration with a direct messaging service like WhatsApp could accelerate that in a big way. And maybe that's why Zuckerberg, back in 2019, tried to reassure investors about that deal, saying Facebook's other products should look more like WhatsApp, saying, as I believe the future of communication will increasingly shift to private encrypted services, this is the future I hope we will help bring about.
All right, well, of course, Meta is a member of the Mag 7, and the Mag 7 certainly hog the spotlight. But according to our next guest, they may not be the best names to invest in. Instead, Nir Kaissar says, look at financial analytics companies behind equity indexes and bond ratings, like S&P Global and Moody's. He writes, they have become as indispensable to the financial ecosystem as Apple is to smartphones or Alphabet to internet search. Nir joins us now. So, Nir, I guess these names have become all the more important, too, as more people buy passive investment products like index funds. And you can see S&P Global as, just an index compiler, or in a way, they're kind of active managers themselves because they decide what goes into an index. For instance, Tesla entering the S&P 500 in December of 2020 because they may or may not meet certain requirements that it laid out for all companies.
Hi, Scarlett. Yeah, I think that's a good description of it. What strikes me is that we were talking about the investment landscape 30, 40 years ago. We would be talking about individuals that were star managers. And, as I say in the column, I think today, inarguably the biggest star on Wall Street is the S&P 500. That's become absolutely unbeatable in the last 10 years because of the performance of the Mag 7 and because of their concentration in these broad market gauges, not only the U.S., but also global gauges that weight by market value. And it's just been impossible to keep up. And because it's been impossible to keep up, it's making index providers, not only S&P, but really everybody in the space, look like geniuses. And it's allowing them to broaden their reach, broaden their brand, and expand their services well beyond just being index providers. So much so that in my judgment, and in the judgment, I think, of a lot of Wall Street analysts, these are businesses with as wide a moat and as much profitability as really any company you're going to find.
You make the case here that we could actually see free cash flow generation out of some of these companies that actually rivals, if not exceeds altogether, what we're getting out of the Mag 7. And I do wonder about that moat, because this is more than just about the inclusion in the indexes. It's about the research and other services that they sell alongside that. And there is a proprietary nature to that research. But more importantly, there is a necessity, at least for certain governments and businesses, there is a necessity to getting that research. Am I right?
Yes, you are. There's a couple things going on here. One is that, there's a brand involved. People like to invest in indexes, let's say, that they recognize, the S&P probably being certainly the foremost among them in the U.S., but there are many others. But also, they have spent the past few years aggregating financial data and other data. And, once you have that muscle, it's not easy to attack. Because you have the scale to deliver financial information, financial analytics, risk metrics, and all of that a competitor can't just compile overnight. Yeah. So it's both the broad reach and the brand, the combination of those two things that I think is what gives them that moat, and also what generates that free cash flow profitability in general. I use free cash flow growth here, but the profitability is also just as robust.
I am curious, though. So do they benefit more from this move to passive investments? And I ask that in the context because, as you know, over the last year, there's been a lot more talk about the need for active management in this kind of uncertain world. So I do wonder, do they lose out if you do see a major shift back to actively manage funds and portfolios? Does that hurt them?
Well, I think what's interesting is they become the active manager. So, it used to be, I think 20, 30 years ago, the conversation was between passive, meaning indexes that track the broad market weighted by market value, or an active manager, a stock picker, a bond picker, or whatever. More and more of the indexes are mimicking what active managers do. And so now it's just a trust question. In other words, who do you trust more? Do you trust S&P's, quality momentum value index? Or, it doesn't have to be S&P's. It can be any of the big index providers. Or do you trust the human stock picker, bond picker? And looking at flows over the last 5 to 10 years and looking at the proliferation of, let's call it, active indexes, I think that people are saying, no, we trust the big data analytics providers more than we trust the Wall Street, fund managers, banks, et cetera. So I think they're going to end up winning the game both in what we think of as traditional passive and active.
Yeah, absolutely. Rules-based indexes. So the other thing you point out, which is really interesting, is that unlike the Mag 7, these index providers and bond ratings companies, they won't go out of fashion. You know, it's not like right now tech is really in. 20 years ago, financials were really in. These index providers will be there whichever sector happens to be in favor.
Well, I think that's the most forceful point for them. I mean, I look at this group and they're sitting out there. They're making, as we've said, as much money or more in some cases as the Mag 7. They are in many cases cheaper than the Mag 7. And I think that they just have more lasting power because, as we know, technology comes and goes. It's very difficult to stay generationally in the technology game. But ask yourself in 20 years, 30 years from now, who are going to be the index providers if they're not going to be the leaders now? I mean, is the S&P 500 ever going to go out of favor? Is ACWI ever going to go out of favor? I certainly doubt it. And I think they have a huge competitive advantage. They will be the kingmakers long before the current kings are around, in my opinion.
All right, Nir, a great column. I really encourage everyone to check it out. Bloomberg opinion columnist Nir Kaissar there. A closer look at, I guess, what he sees as two really potential hot stocks, and they're not necessarily in the hottest of industries there. All right, we're going to set you up for what to watch tomorrow, including some results out of Walmart. This is Bloomberg. All right, shares of Walmart, they had their best year in about 25 years back in 2024, and they're starting 2025 with the best start to a year, going back 3 decades. Of course, all that is on the line as they're expected to report results tomorrow. Joining us is Jaewon Kang from our Chicago bureau who covers this company for us. And Jaewon, let's start off with the numbers. What are investors expecting to hear tomorrow?
Yeah, so overall, Wall Street is expecting a healthy quarter for Walmart as people prioritize value and essentials like groceries. For comparable sales for Walmart U.S. stores, we're expecting an increase of a bit over 4%. And in recent quarters, we've also seen that the company's digital offerings like online delivery and pickup are helping bring in more consumers who appreciate the convenience that these services offer. So we're expecting to hear more color about those tomorrow.
How much color do you think we'll get when it comes to tariffs? Because so much of Walmart's goods are imported because the company's mission is to offer value to its customers.
Yeah, so macroeconomic uncertainties are definitely on top of mind, especially tariffs. I think the industry is sort of on standby looking at, when they're going to be enforced, which products, they're going to affect, and Walmart certainly isn't immune to that. That said, the company has said it's operated under a tariff environment for a while now, and that it's been diversifying its supply chain. So those things should help it navigate through those things, and we'll, definitely be looking out for more commentary on that.
Do you think that we actually learned anything, Jaewon, from some of its competitors like Target, or is the story tomorrow going to be very specific to Walmart?
Yeah, I mean, as always, Walmart serves as the barometer for the U.S. economy, being the largest retailer. And this quarter also includes the holiday season, which is really important for the industry. So, a lot of shopping gets done. It also shows how healthy the consumer is. And so far, the signs have been pretty positive. Target raised their forecast for the fourth quarter after the holidays went better than they expected. Mm-hmm. So we'll, definitely be looking out for color on how the holiday season went and what people are buying and what that says about the economy.
All right, Jaewon Kang in our Chicago bureau, of course, the greatest city in the world. Meanwhile, back here in the second city, we have our eyes on a few other potential things that could move the market. Just go with it, Scarlett. All right, we get some other earnings other than Walmart tomorrow morning, Scarlett.
Yeah, we're going to hear from Alibaba, from Shake Shack, from Wayfair, TripAdvisor, and my favorite company, Birkenstock. I own like 60 pairs of shoes.
You are the Birkenstock queen. And it'll be interesting to see the read on consumer spending, particularly with some of those items are probably more discretionary than they are staples. Aftermarket, we get a few names as well that could also give us a peek into discretionary spending, including from Booking Holdings and Rivian.
Yes, that's right. And Black and Live Nation, too. And I think about that, especially with the ticket prices to live sports events and concerts really being a contributor to inflation over the past year.
Absolutely. And of course, Rivian really in focus coming off of course, the bankruptcy filing by Nikola. Not saying Rivian's anywhere
Not really
close
comparable,
to that.
but yeah.
But of course, a lot of people want to make sure that these upstarts are healthy. And then at 7 a.m. tomorrow, right here on Bloomberg Television, an interview with the Treasury Secretary of the United States.
Scott Bessent will be joining Team Surveillance, so be sure to tune into that, 7 a.m. Eastern time. And that precedes an important data point, jobless claims at 8:30 a.m.
Yeah, those weekly numbers here. Maybe we get a little bit more insight into how healthy the labor market is. And if that's not enough, we are going to get some Fed speak out of quite a few people who maybe will also opine on that, including Goolsbee, Muslim, Abar, and Kugler. Who you got?
I always like listening to Goolsbee.
Do you, really?
Yeah, I think he has a lot to say.
All right, that does it for us here on The Close. Join us tomorrow for all of your market-moving coverage. For your politics coverage, Balance of Power is up next.